The market is trapped in a volatility cycle driven by one variable, whatever Donald Trump says about Iran next. Let me show you what the last 72 hours looked like, because this is not normal, even by 2026 standards. On Monday, June 8th, an Iranian Shahed drone shot down a U.S. Army Apache helicopter near the Strait of Hormuz. Trump confirmed it the next day. By Tuesday night, American forces struck Iranian air defense systems, ground control stations, and surveillance radar sites. Iran answered Wednesday morning with ballistic missile attacks on U.S. bases in Bahrain, Kuwait, and Jordan. The fragile ceasefire that had been on life support since April collapsed. Then came the whiplash. Yesterday, Trump posted on Truth Social that Iran has taken too long to negotiate and will pay the price. He said the U.S. would strike Iran hard and take control of their oil infrastructure, including Karg Island. Oil jumped to $90.10 a barrel. The VIX spiked 11% to 22.10. The Dow lost 953 points. The S&P 500 fell 1.6%. The Nasdaq dropped 2%. Supermicrocomputer alone lost 12% after announcing a $7 billion equity offering, the latest in a wave of AI companies tapping public markets for cash. And today, Trump said he canceled the strikes. A deal is imminent. Again. The Dow surged 900 points in a single session. Markets reversed. The VIX settled back to 21.41, but that is still elevated. Anything above 20 signals genuine stress. This pattern is not random. It is structural. The market is being held hostage to a binary outcome it cannot price. This is the 38th time Trump has declared an Iran deal imminent. He has said it 37 times before. The Strait of Hormuz has been functionally closed since February. 20% of global oil flows through that choke point. It remains blocked. ExxonMobil warned this week that oil inventories will hit critically low levels within weeks. And still, every new statement from the White House yanks the market in the opposite direction. The CPI report released this week adds a second layer of pressure. Headline inflation hit 4.2%, the highest since April 2023, and well above the 3.8% we saw in April. Energy costs are the primary driver. Gasoline prices surged 23% in May alone. Jet fuel rose 22%. Home heating oil up 16%. The Iran war is now directly imprinting onto consumer prices. The Federal Reserve meets June 16th and 17th. Rate cuts are off the table. Bond futures are now pricing in a rate hike before year-end. Core inflation, which strips out food and energy, came in at 2.8%. That is still above the Fed's 2% target. But the headline number is what Main Street feels, and what the White House fears with midterms approaching in November. Gold is caught in the crossfire. Citi warned this week that gold could drop another 20% by September if the Strait stays closed. The safe haven is being sold to cover margin calls in equities. Silver is down 0.5%. The metal that usually rallies on chaos is falling because the chaos is inflationary enough to force rate hikes. That is a signal worth watching. So where does this leave the market? You have three scenarios on the table. Scenario 1, a genuine ceasefire or deal that reopens the Strait of Hormuz. In that case, you get a massive relief rally. Oil drops $20 a barrel overnight. Inflation expectations reset. The Fed stays on hold. Tech and consumer discretionary lead the charge. Scenario 2, continued escalation. Tit-for-tat strikes that keep the Strait closed through summer. Rystad Energy says oil could hit $150 a barrel if this drags on. At that point, the economic drag becomes severe. You get a full correction, possibly a bear market, and the Fed is forced to choose between fighting inflation and preventing a recession. Scenario 3, the one we are living in right now, perpetual whipsaw. The administration says peace is coming, strikes anyway, then says peace is coming again. The market oscillates between hope and fear, range-bound, directionless, brutal for momentum strategies. This is the volatility trap. Here is what I am watching. SIBO options data for June, the first full read on zero DTE volumes under the new PDT rules. The WASDE crop report tonight, PPI data tomorrow, and most importantly, whether the Strait of Hormuz sees a single commercial tanker transit this month. That one data point matters more than any headline. If you are trading this environment, position size matters more than your thesis. The market is not pricing fundamentals. It is pricing Trump's next Truth Social post. Respect that. Use options for defined risk. Avoid oversized bets on direction. And do not let a 900-point Dow day convince you the volatility is over. Until the Strait of Hormuz reopens, until CPI starts decelerating, and until Trump stops declaring deals that never materialize, Every rally is suspect and every sell-off is buyable, but neither is sustainable.
I am Daniel Reed.
Keep your data sharp and your logic sharper.